Welcome back to the channel. I'm Foreman, and in this video I'm going to be talking about the UK stocks that I'm buying right now. And if you like the video, please drop one of these to help support beat that YouTube algorithm. According to Google Finance, the FTSE 100 is down 0.41%. The FTSE 250 is also down 0.23%. And on the contrarian side, the S&P 500 is up 1.75%. My portfolio has done quite well this week, recovering from what has been quite a devastating last few weeks, and I've gained 3.84%. This is likely due to my biggest holding. They've had somewhat of a consolidation in the shares, although in the short term I really cannot predict what may happen, and so I am just going to continue accumulating in some of my stocks and then look for the longer term and hope that I will continue to outperform by investing in stocks with long-term growth potential and those that have underlying value in their financials and fundamentals, so that when they continue to grow upon that at faster rates than the average company in the market, that they would then deliver value to shareholders, not necessarily in the form of dividends, but rather in the form of financial growth. However, that's not stopped me from investing in a few dividend stocks, which I will be talking about later in the video. When we start today, looking at the screen, I'm looking at the network difficulty. This relates to my third largest holding, Argo Blockchain. They're a Bitcoin cryptocurrency miner. They also mine a bit of Zcash, but not much. They usually sell that and reinvest it back into Bitcoin. We can see that for the miners, the network difficulty has been increasing. I'm sure you've been following the Bitcoin price trend though, so if we take note here on the chart or the graph, that in May 21 or 2021, we can certainly see that's where the difficulty has peaked in the last year. But when we look at the price action in the last month, we can certainly see that there is a trend here where actually we're much lower in terms of difficulty and network difficulty compared to where the price is now sat. Obviously, May was when we last hit, well, when we were likely in our last part of the all-time high period for Bitcoin. But it is interesting to see that the difficulty is still lower. And that's likely due to the shutdown of operations in China, which I think has really been a positive impact for the likes of Argo Blockchain, as they are a North American-based cryptocurrency miner. Although, according to this, Argo Blockchain shares have really not moved by much, and this is 2.52%. I suspect this is due to the lockup period with the Nasdaq, and that's causing shares to be a little bit slower than a lot of the other Bitcoin mining companies, although this is perfectly fine. I'm happy letting this stock sit because at the end of the day, they're still mining Bitcoin. They're still mining a fair amount. At the moment, they have 1.07 exahash of mining power. This should equivalent to a little bit more than 160 Bitcoin that they are mining, or they did mine in the last month, and closer towards that 200 figure. However, we are seeing that they may be shutting off their machines for the optimized efficiency. I speak more about this in my Argo Blockchain stock analysis, so click that card at the top right of the video if you are interested in it. The idea here is that I think Argo Blockchain are going to continue to build their hodl of Bitcoin. And as this increases, as Bitcoin increases, which I do think it will continue to do so over the short to medium term, Argo Blockchain's underlying fundamental value is not only going to increase from the assets on their balance sheet, but also from the continuing mining operations that they have ongoing. They also have that Texas facility, which is coming down in the next year or so, and that will really ramp up their overall mining power and allow them to really stack more Bitcoin onto their balance sheet. We've also got news with Boohoo this week. Shares, according to Google Finance, are up 1.56%. However, if we look at the close of Friday the last week, it's much closer to 4 to 5% instead. And Boohoo has created a partnership with Megan Fox. And I think this is particularly interesting because Megan Fox is certainly a very famous person. A lot of you might go, well, she's a washed up celebrity. I've not really heard anything from her in a while. Well, sure, you can say that, but then you look at the likes of Instagram and she's got 17.3 million followers. So there's certainly something here where she has a considerable amount of value. She is someone that is definitely an influencer in this space, and with that link in her description where she has immediately got this Boohoo link, I think this is going to be promoting a lot. And I think this is a very good move for Boohoo. Even if the products are seen as a little bit more expensive by the usual customer base, I think this is a great way to continue the marketing that they are very good at. And we've also seen the likes of T. Rowe Price fund, well, basically another institution, and they've bought a significant amount more shares. As we can see here, the total position of persons subject to the notification obligation is a fanciful way of saying that previously they owned roughly 10% of the voting rights or 10% of the company, and now they hold around about 11.1%. This is quite a significant move up, and that's a stake increase of a good 10 to 11%, and it shows very good commitment to the company and that they are interested in buying this dip. When we look at the overall top shareholders of the company, they're getting very close to the chairman himself, Mahmood Kamani, and I think there is certainly a chance here that they may try to accumulate more shares. The one to watch though with Boohoo is the likes of Jupiter Fund Management. They have been quite notorious in accumulating shares of Boohoo, and since the last update was reported on the 22nd of September, we may see some more further buys coming shortly. Although I may remember, and this could be speculation, that they may be capped to 10% of their portfolio invested in the likes of Boohoo, but it still would be very interesting to watch that space. We've still not seen any director buys yet. The individual insiders do hold 20.2% of the business, but overall there's not really been any activity since mid-June. So it will be very interesting to see if there are insiders buying in. This could certainly push shares up slightly and could be very much interesting. Obviously, I don't think it'd be wise if Boohoo initiated some form of share buyback plan. I don't think that's very wise at all, because I think they can reinvest their capital back into the business and continue growing, like with their capital expenditure in increasing their warehousing capacity and really pushing out for longer term growth, and just at the moment surviving through the short to medium term freighting issues and shipping costs. Obviously, at the moment, their EBITDA, earnings before interest, taxes, depreciation and amortization, is certainly under pressure. But they are not alone in this. And in fact, their industry is in complete pressure from this, as well as other industries too. And I think this is going to be a knock-on effect in the markets, where we see this direct effect on some of these businesses. These businesses then start to struggle. They perhaps aren't paying for as much services that they need. That impacts other businesses, and we can see that knock-on effect. This could be a form, or we may see a correction due to this, although the markets are pretty much forward-thinking. So I think that would already be priced into the markets, but let's say the condition worsens, or for instance, the Christmas period is very difficult, and instead of panic buying, there's perhaps some serious concerns with the overall supply, then this could lead to a knock-on effect. However, at the moment, I think the markets look fairly sturdy. I say that with absolutely no knowledge of it. I'm saying that as complete speculation. I have no idea. For all I know, after I upload this video, the whole market could crash 10%. I'm just giving my own views. And to be fair, what really does irritate a lot of investors is that the market is rarely logical. If the market was perfectly efficient at all times, it would be almost a little bit too easy. So I've stuck to my plan, which I'm very grateful to Lee Freeman Shaw. This is a very successful fund manager, and he managed to hire a fair few famous investors for his fund to see how they would do. And he's had the access to see all of their trades, and what he'd found is that a majority of the time their trade ideas were actually poor and they'd lost money. However, overall, they still made millions and millions of pounds. This book is The Art of Execution. If you'd like to grab a copy of this, I'll leave a link in the description down below. But what I'd learned, and one of his sayings in this book, is that when a stock drops by 20%, he then puts pressure onto one of his fund managers, or the fund manager that is holding that respective stock. He then says, look, you need to be either considering to buy a lot more of this stock, you should either look at cutting your losses, and do not sit idly, because if you sit there idly and it continues to drop and you don't do anything about it, you're effectively just bleeding capital. As Warren Buffett has famously said, rule 1, don't lose money. Rule 2, don't forget rule 1. So obviously there is a lot of pressure in not losing money. My stock in particular, Boohoo, had dropped by roughly 20-25% from my average price. So naturally I was buying more and I was pushing these shares down, because ultimately the story hasn't changed. Yes, their cash position is going to be weaker now, and it is considerably worse. However, I have my beliefs that they will continue to push through with this investment in capital expenditure. They're now seeing a rise in demand once more, and they should do very well. So I bought 349 more shares. However, in order to accumulate this and afford this at the moment, the temporary fix was to sell the rest of my position with Team 17. I've had this argument before. Team 17 and Games Workshop, they both compete for your time as they are both entertainment businesses. Both of them have exposure into the video games industry, and I thought, you know what, I'll stick with Games Workshop over the likes of Team 17, hence why I've definitely pushed down my position, especially as Team 17's industry valuations are certainly quite a lot higher because there were acquisitions in this area like Codemasters by EA, and I believe quite recently there was another bid too that I have now completely forgotten that was bought by a Chinese firm. If you can remember that, please leave a comment down below. So naturally, I've pushed away from Team 17 for now. It is in my watch list and I will be interested to buy, but I'm going to look for shares to drop a little bit more. At the moment, I am a lot more interested in my other holdings, and so I'm keeping quite calm. Speaking of my other holdings, I've got Games Workshop. Shares are up 2.54%. In fact, this week I did a miniature audit. I went into the local store, I investigated, I spoke to the employee. I found out quite a wealth of useful information that I believe most shareholders of Games Workshop are not aware of. I'd found out how the employee works, what kind of things he personally would look for in his job, is he well rewarded by the company for his actions, and what it is like and how they interact with the community. If you're interested in this miniature audit, I actually made my stock analysis on Games Workshop this week. The video has not done very well at all. I don't know if that's because you guys aren't interested in Games Workshop, or perhaps it was just a flop of a video upload and YouTube's algorithm has sabotaged it. Either way, I'm going to leave the card at the top right of the video. It is by far my best made video yet, with more detail or information that I'm putting to my Boohoo or Argo blockchain stock analysis. So if you're interested in that, the card is at the top right of the video. I have also been looking at dividend income a little bit more. From my secondary portfolio, I've been quite interested in it. I thought, you know what? So I should look a little bit more into it because this recurring cash flow is quite inspiring. Games Workshop, I now hold 75 shares. This is the same as last week. However, when we total up, when we take into account the dividend cut, and I'm going to assume that using dividend data that we're going to ignore the Q3 dividend, and let's assume that that's not there. So instead we have 45 pence, 50 pence, 40 pence, 25 pence. This, I think, was roughly, 95, 135, 160 pence per year in annual dividend income from Games Workshop. When you have 75 shares, that's equivalent to £120 a year of dividend income, just for sitting there and holding the shares. Whilst to me that's quite a lot because I'm not used to holding any higher yield stocks, for instance, and currently the yield of roughly 1.78% or something like that. Dividend data is wrong, obviously. I think that this is actually quite impressive. This means that I could buy a free share of Games Workshop, providing the shares don't push up any further each year. And I expect that the company will grow. I think they will grow their financials as they have been very well. And I think that they will also grow their dividend when they have more surplus cash. And so it makes a lot of sense. And I think I'm just going to keep piling into these shares, and this dividend income I can then hold as cash for the next crash correction, or I can reinvest it into other holdings. And that's the beauty of dividend income. Providing the dividend isn't cut, we could be seeing a market downturn. We could be in an extended bear market where the markets are just consistently stagnating or dropping down or trading sideways for over 12 months. In that time period, that dividend income would be very useful, providing you also have working income, so then you can really maximize the opportunity that would be present in this sort of market scenario. And then also Dunelm Group. I wanted to speak a little bit more about this. I've acquired 3 more shares this week in my smaller SIP portfolio. I now hold 6 shares. This means I have £1.50 a year in dividend income, just from 6 shares of Dunelm Group. I imagine, like Games Workshop, this will continue to grow as well. I think this is quite impressive because £1.50, it may not seem like a lot. But then you could probably buy 8 Freddos. No, that's probably completely wrong. You could probably buy 1 Freddo in a year's time, knowing how much they've increased in price. But you get the idea. That's £1.50 that you wouldn't have had before. Obviously, that's the same as finding a penny every other day of the year, which I suppose really doesn't seem like a lot, but it adds up. And it's those little things. And then with that, you could just continue to buy a little bit more. 6 shares of Dunelm Group really isn't much, but it goes to show that when your capital is invested and your money is working for you, even if whilst you are working for your money at the same time, while is that money working for you, you're getting more income, and it's going to slowly build up, and you can see how it can compound over the longer term. One thing I was quite interested is, and I've been speaking to what I would consider is my mentor. He was very successful in the corporate chains for various big businesses, although I'm not going to name them just for the sake of anonymity. To be anonymous, effectively. That was the idea, or anonymity. I tried. 4 failed attempts. Anyway, the idea here is that if a company is still growing, but they're not opening any more stores, and I noticed this with Games Workshop as well, or perhaps they're disposing of more stores than they're opening, then there's certainly a potential there, because if they're already growing their revenue and earnings, opening more stores is only going to increase that even more. And Dunelm Group is a prime example of this. Their capital expenditure for the full year of 2021 was £15.7 million. This included 1 store and 2 relocations. Only 1 new store. Obviously, they invested elsewhere, but over the medium term, they'd like to spend £30 to £40 million per year, which would mean that half of this investment would be in what they would like to have to 3 to 5 more stores. Imagine if they continue to invest in these new stores, building them up in prime locations, because they don't have to be in the center of town, so they don't need that prime real estate. Instead, they buy leases or some freeholds elsewhere, and they then build up their own community around it. I really love these companies that build their own community around their business, as you're effectively hitting 2 birds with 1 stone. I don't know why I did that. But then when we look at how they are interacting with their community, they are doing their Dunelm Delivering Joy campaign, which is the whole idea that this is returning for the 2nd year, and last year they donated 18,000 gifts for Christmas. That's the whole idea. They're interacting with their community, they're taking part, they're trying to get some donations in, and they're going to try and spread that out and donate to charity. Overall, this is really not going to impact the business revenue or bottom line by that much at all. But it's impacting the community. It's making their brand more well known. Much like their local Facebook groups that I believe now have 700,000 members in their groups. They are certainly expanding their brand awareness, and at the moment, as far as I'm aware, they're only located in the UK. I don't see any reason why this business model wouldn't work in other places when they look for that form of growth potential, or perhaps there's exciting new areas where they could look for further vertical integration. So there is certainly growth potential for this business in the future. Sure, I believe their market cap leans closer to £3 billion than £2 billion, but I still think there is growth potential for this. And at the same time, whilst they're paying a dividend of roughly 2.74%, I think I would be very happy with this income. It's a slow, more steady investment, even though shares have dropped by over 20% in the last month, and I think it will continually generate shareholder value. And that's why I hold it in my SIP. If you're interested in that Games Workshop stock analysis, that card is at the top right of the video. I hope you enjoyed. Have a fantastic week.